Hello, everyone. This is Arlan Suderman, Chief Commodities Economist at StoneX, and we're back for another USDA WASDE report discussion today. Overall, and I guess I should get the make compliance happy here and get the disclaimer up while I'm talking, but overall, not really a big surprise about today's report. There were some significant numbers which we were talking about, but most of the numbers didn't change. Now, the numbers that do have some significance, and we will certainly discuss that. But as I often do, or actually almost always do, start with price as a function of supply and demand as modified by the flow of money. And this is Federal Reserve Day. So let's talk about Federal Reserve. But first, I wanted to point out this usdebtclock.org graphic, which you can find on the website there, and you put your cursor over any one of these numbers and it'll pop up a little box to explain what that is. National debt at $34.8 trillion. And as I looked at the Federal Reserve today at their dot plot graphic calling for longer term interest rates around 3%, I do not see that happening with this happening, what you see in front of you. With our national debt growing at the pace that it is, and there in the center of the screen, you see that I have circled that our annual interest on our debt at $865 billion. Now, that number is going up fast for those of you who are long-term with me, and I've periodically have had this on here. I looked at this number on Friday, and then from Friday to Monday, the interest on our national debt had gone up by $5 billion. Now, I have trouble comprehending what $1 billion is. I know it's a number with a lot of zeros behind it. Yeah, I know how many, but just comprehending just how much that is. But yet 5 billion in just a few days' time is how much, and that's how fast it is going up. And so that is going to create some problems in our credit markets. And by putting all these debt certificates, a record amount of debt certificates being offered onto the market this year. We're increasing the volume of debt certificates being offered to the market by more than a third across the yield curve is the current estimate. And you have to find enough buyers for that. And some foreign entities are withdrawing or pulling back from buying our debt certificates for various reasons. And the Fed had been reducing what they were buying as well. And so the Fed has already had to slow the pace at which it's shrinking its balance sheet to make sure it was still buying some of these to keep those interest rates from going too high too fast. And that resulted in a turn lower in those mid and longer term of the end of the yield curve. But longer term, there's only so much they can do there before they just have to come back in and full-fledged start to buy or allow those interest rates to go higher. They only control the overnight rate, but eventually the market's going to pull this higher. And I see a more likely scenario being more of an interest rate environment like what we saw in the 90s and the early 2000s. Hopefully it won't be more than that. But that's kind of the baseline where we're at. Now, if we look at the Fed, of course, they paused the interest rates going up at their July meeting last year, and they haven't gone up since, and that includes today's meeting. And they've basically ruled out a rate hike this year. They say the most likely next move will be a rate cut. But there's nothing in the economy right now pushing them to do a rate cut. If they did it, there's still enough stimulus in the system that we could see amped up inflation, and they don't want that. If we look at the inflation, this is adjusted for this morning's numbers. You can see that headline CPI, Consumer Price Index, is just going sideways right now. It's not getting closer to that 2% mandate. Been over 3% now for over 3 years. The core number is slowly leaning down and leaning lower. But had it not been for a 0.5% month-on-month drop in car insurance rates, that's what offset the increase in housing costs over the past month in the month of May, and gave us the numbers that we did this morning, which came in better than what the market expected. And so that's why Wall Street was celebrating. And in fact, the Fed has been focusing a lot on what they call their super core inflation rate, and it only inched down from 4.88 the previous month to 4.80 this month. So not making the progress. And in fact, Fed Chair Jerome Powell, who's finishing up a press conference as I speak, has been emphasizing on there, as I've been following some of the subtitles, and the fact that they've been pushing back the rate cuts in their forecasts on the dot plot graphic, primarily because we haven't been making the progress on getting inflation down that they had hoped that they would. And so that's the path that we continue to be on. In fact, if you look at Bloomberg's measure of sentiment in the speeches given by various Fed members, it's turning more hawkish once again. Now, if you looked at, this is an interesting, I just want to look at a couple measures of the economy. And I pulled this auto sales data, I was looking at it, because I'm in the market looking for a new car here soon, sometime this summer, and trying to time it. And new car sales are actually trending higher. Well, that's an indication that consumers are still buying. Now, if we look at restaurant sales, it's going the other way. We're seeing them pull back because food costs, particularly if you look at away from home food costs, which would be restaurants, have gone up significantly, particularly at some of the fast food restaurants. And a lot of that's due to wage inflation and providing you the service of serving you that food. If we look at TSA checkpoint numbers, setting records this year, and see they're circled this year's numbers, running well above 2019 levels. And so people are still traveling as well. Now, interesting dynamic here. I'm going to set the stage a little bit for this next piece of data I'm going to talk about. If we look at cell phone activity in downtown areas of various cities as a way of, measuring people working in offices. And you can see that a lot of cities, the cell phone activity relative to during working hours relative to 2019 levels, pre-pandemic levels, is a third or a half less than what it was in 2019. And so what I share that with you for is to talk about commercial real estate and the vacancy in commercial real estate trending higher after COVID. And why is that significant? Well, because when you look at commercial and multifamily maturity, loan maturities, there's a lot of it in 2024. So this kind of shows the other side of the coin, where we could have problems in the commercial real estate sector developing with all the open offices. A lot of people still working from home. Now, our company is like a lot of other companies trying to get people back to the office, but a lot of companies apparently have not been successful at doing that in this current environment. I think if you see that unemployment rate start to go up, companies will be a little more successful in getting people to come back to the office, but that hasn't happened yet. And with unemployment still below 4%, we are seeing the quit rate go down, but we're not seeing we're still seeing a tight jobs market overall. Now, as I indicated before, monetary base did take a turn lower in some of the latest data, but overall, we're still trending higher. And that's largely because some of the fiscal stimulus, I believe, and including student loan forgiveness, which means that money is now available to be spent. So even though the Fed is shrinking its balance sheet, typically that would mean a decline in the monetary base, which is similar equivalent to M2 money supply. But in this case, that is trending higher because of some of the fiscal decisions that have been made by Congress. Okay, so when we look at commodity prices, you see overall, we're still kind of trending higher here on the right-hand side of the graphic. Now, 5-year break-even inflation rate broke lower after that May report, the May Fed meeting. And then it had started to turn back up again. I'm anxious to see what it does now after this Fed meeting. and see what that does and how that might affect money flow into the commodities. But we're seeing a lot of ebb and flow right now in this transition period between funds who think that inflation is coming back and those who think that no, it's going to continue to trend lower. And there's an ebb and flow in that right now is kind of which way is it going to be. I still believe in the longer term reinflation is going to be a problem. We saw the big short covering rally this spring in the commodities as a result of that expectation of reinflation. But then prices got too high relative to the fundamentals, and we saw a sharp correction back lower, first in crude oil, and then in corn, then in soybeans, and then in wheat. And we're still trading these fundamentals at a higher level than what we would have 6 months ago to a year ago, because we're no longer so much in a commodity deflation mode, but we haven't really swung the pendulum all the way. So we're continuing to monitor that. Here it is versus the 2-year break-even inflation rate and versus the CPI. You've seen these charts before. And obviously, you may want to come back and look at the on-demand version of this and study these charts some more, but I don't want to spend too much time on for those of you who have seen this before. And this is specifically looking at the grain and oil seeds versus the CPI. Okay, managed money, starting to see a little bit more creating short positions here over the last couple of weeks. Once again, we see that in corn, we see soybeans less so, where managed money is back to net zero or close to that once again. Chicago wheat get still modest short positions, but not the record short positions we once had. In Kansas City still trending toward reducing those short positions. Okay, let's talk about weather. I want to talk about the 45-day period between mid-April through May. East Texas, wettest period for that time of the year on record out of 132 years. Same thing was true for Northwest Iowa. North Central Iowa, the second wettest on record. West Central and Central Iowa, the third wettest on record. So you can see here that we had significant moisture fall in some previously really dry areas from mid-April through the end of May. And now some of those areas have started to dry back out here over the last couple of weeks, particularly Iowa. We're still staying fairly wet. In fact, some heavy storms in southern Minnesota again today. But then northwestern Midwest has had some real problems with ponding and stuff. Now where it's not ponded and where they haven't had to replant, the crop looks generally pretty good. But that is a factor we're watching. We're watching for any prevent plant, but right now the market is assuming prevent plant won't be more than it is normally, when normally it's 3 to 4 million acres of prevent plant. If we look at what it's done to the soil profiles versus January 1 on the left and the 4th of June, so a week ago I created that graphic, we've dramatically improved things. Do we have some dry pockets? Yes, we do have some dry pockets, but we're dramatically better off in the top 40 inches of soil than what we once were at the beginning of the year. Now, I want to talk a little bit about this, and this graphic, which I've shown you before, but I want to highlight it a little bit more. And this is a graphic made by Eric Snodgrass with Nutrient Solutions. So I want to give him credit, and some of it comes from tropicaltidbits.com. But first of all, I want to focus on this area up here, Gulf of Alaska stretching over toward Japan. That's an area that's seen cool waters. Underneath of it, we've seen these very warm waters. And that's what's given us the overall pattern that we've been in. Then you have cool water stretching from California down to Hawaii. The models have been expecting this warmth in the central northern Pacific to really spread into the Gulf of Alaska. And if that happens, then you tend to set up a high pressure in the southwest, and the storm flow would kind of dip down in the northwesterly flow across the Midwest. And when you do that in the last half of June through July and August, you get these cluster storms that develop on this northwesterly flow. And yeah, occasionally you get a derecho or something like that, but you tend to get these cluster storms, which can give you some high winds. And we're already well above average in high winds and hail reports and even tornadoes this year. But that gives you a warm, wet type of scenario that historically typically favors high yields, above trend yields anyway. And so that's going to be the key. Now, we also have very warm temperatures here in the central Atlantic and the Gulf, and expected to be a big hurricane season. Lots of hurricanes. We don't know how many, if any, of those hurricanes will hit the U.S. It may be a lot of them. We hope not. It may be very few or none. We don't know, but we do expect a lot of hurricane activity, which does increase the risk for the southeast and the east. So we'll have to keep our eyes on there. And then you see the developing La Nina with cool waters in the equatorial Pacific. So having said that, I'm going to clear this off. What if this fills in with warm? I mean, what if this stays cool up here or even gets colder in the Gulf of Alaska? Well, then that tends to give you a high pressure right here. You get a high pressure right here, and then you get a high pressure right here. So we've moved what was in the southwest, we've moved it northeast, right over the Midwest, which gives you a hot, dry summer. Which are we going to have? Now, I want to show you what's happened in the last 7 days, is we have really cooled off this area. That's the wrong direction for wanting to have a favorable weather pattern in the Midwest. That may not be the long-term pattern. And we did have a low pressure sitting over that area over the last 10 days to a week to 10 days, creating that coolness. And that is now breaking up. So we may warm that back up, and the models seem to think that we will. But if we don't, that increases the risk of high pressure over the Midwest. If we do warm that back up, then that supports more of that southwesterly high pressure, where you get the cluster storms riding over the top of the ridge and a northwesterly flow over the Midwest. Will probably sets one or the other up over the next 3 weeks. Right now, the models are calling for high pressure with some heat to build over the eastern Midwest in the days ahead, and then slowly migrate to the west and to the southwest. And that would give us longer term a southwest high with those northwesterly flows. But the models have had a really bad track record over the last week or 10 days. So we don't know how much confidence to put in that. So that's the weather story. I wish I could tell you what kind of growing season weather we're going to have in the Midwest. And the bias of the forecasters still leans toward the warm, wet scenario. But to be honest, we really don't know. And these next few weeks will tell us a lot, I think, about what to expect over the rest of the growing season. Let's look at the fundamentals. First of all, I want to insert this a little bit of interest, because I'm getting a lot of questions about acres this year with prevent plant talk, and can they get the crop planted in some of these wet areas of the northwestern Midwest, et cetera. The market's not going to care, is what I'm saying, because it's too hard to do USDA's math on acreage. I mean, look at the March planting intentions report that lost 6.9 million acres. No explanation. Where did that go? If you look at 2019, prevent plant acres, 19.5 million acres. But harvested acreage didn't drop by 19.5 million. The acreage just doesn't add up. And I'm not trying to promote a conspiracy theory or anything like that. That's not the case. But it's really hard to put together the acreage numbers from USDA to have some consistency. So don't get too caught up in it. Every year we have 3 to 4 million acres of prevent plant. That's what the market's going to assume. We may get acreage changes on June 28th, and the market may react to that in the short term. The other factor is the graphic on the left here shows what's happened to conservation reserve acreage between 2007 and 2020. we've lost a lot. Now, some of that has gone into other conservation programs, but we've lost a ton. And to be more specifically, about 15 million acres from 2007 to 2020 based on this graphic. Now, what's happened to major crop acreage? That's the graphic on the right. So overall, when we look at CRP acreage and updating that number, 21.9 million from 2020, that rose to 24.8 million in 2023. So from 2020, it did go up by about 3 million acres, but that's still down 12 million acres from 2007. But yet major crop acres are only up 1 million acres over that period of time. So what happened to the other 14 million acres? Oh, 11 million, I'm sorry, other 11 million acres? We don't know, can't answer that. My bottom line is, don't think conspiracy. It's not going to do you any good. The market's not going to trade it. The bottom line is that just understand the market can't understand it, so it's not going to trade the acreage story. Unless it has a clear acreage story there to trade, it just gets confused by it. It's going to trade yield. It's going to trade USDA production estimates. It's going to trade crop ratings, which are affected by the weather pattern that we have established. That's what it's going to trade. So with that in mind, let's look at what USDA's latest numbers are. U.S. old crop ending stocks, no change for wheat. Corn going up just by 13 million bushels, very small tweak there. Soybeans up by 10 million. I'm sorry, no change in corn. I said there was a change. I was looking at the average trade guess. No change in wheat, no change in corn ending stocks. And soybeans, the only change really they made was they cut crush by 10 million bushels. Didn't make sense to me because crush year to date is ahead of the pace needed to hit USDA's target even after that very poor April crush number. May crush number will get out here at the end of the week for NOPA. I expected somewhat of a bounce back, but we'll see, and I'll show you more on that in a little bit. If we look at South American production, really surprised they didn't cut Argentine production more. Left it unchanged for corn, for soybeans. I didn't really expect much of a change in soybeans, maybe a small tweak, but the corn number, private estimates are in the mid 40s, so well below USDA's 53 million metric tons there. Brazil corn, no change in this report. I guess USDA is waiting until they get more harvest results there. On the soybean side, they dropped another million metric tons with the losses that we see in Rio Grande do Sul down to 153. Our latest StoneX Brazil estimate is at 149. Okay, all wheat production of 1.875 billion, up about 17 million bushels from last month. And I'll show you where that is here in a little bit later. I've got a graphic. But that's 5 million less than anticipated by the market. All winter wheat at 1.295 billion, down 3 million from what the trade expected, up about 17 million or so from what was anticipated. Hard red winter wheat up 21 million bushels and about 10 million above what the trade was anticipating. Soft red winter wheat actually went down 2 million bushels, came in about 8 million below what the trade was expecting. White winter wheat, 226 million bushels, and that was down 3 million from what the trade was expecting, and down 3 million from last month. Looking at new crop ending stocks, wheat 758 million bushels, pretty close to my 762 million, about 20 million less than the trade is expecting. Corn at 2.102 billion, identical to what my estimate was at. That kind of worries me a little bit when I agree with USDA. Average trade guess came in at 2.079 billion. Of course, that was not a change at all from the previous month as far as USDA's number. When we look at soybeans at 455 million bushels, USDA continues to move toward my estimate. Global ending stocks for the new crop marketing year, basically a little bit tighter on wheat, Russia down 5 million metric tons, 83 million metric tons. Ukraine down 1.5 to 19.5 million metric tons of production. But offset that with on the demand side to a great extent. Corn numbers dropping about 1.5 million metric tons, very close to where the trade estimate is. Soybeans dropping less than 1 million metric tons, very close to the average trade guess. Nothing really market moving there. If we look at where we're at year to date corn use for ethanol, we still exceed the pace needed to hit USDA's target by about 42 million bushels. Now that's down from about 49 million bushels a week ago, but we're still exceeding it. When we look at export shipments, export inspections actually to be technically correct, we're ahead of the year-to-date seasonal pace needed to hit USDA's target by about 26 million bushels. And we look at why that is, it's because of a 45% year-on-year increase in corn sales to Mexico. And with the drought currently in Mexico, we may see a repeat of that strong export sales in the coming marketing year as well if that drought holds. But here's what's concerning is the poor new crop sales of corn, just not there. Buyers just aren't worried about tighter supplies or higher prices, so therefore they don't see an incentive with carry in the market to buy ahead, and they're not. When you look at the crop ratings for the corn crop, really pretty good at 74% good to excellent. And, Kentucky has some problems, but no significant problems. I guess Texas has some problems as well, but they're starting harvest there. When you look at the balance sheet, again, here is USDA's old crop balance sheet, and here's their new crop balance sheet. You can see not really any changes this month. The key here, and my ending stocks projection is about, what is that? 102, I'm about 80 million bushels above USDA on new crop. No, wait a minute, I'm right, I was looking at the wrong column. We're about the same there, okay. We're basically the same on bottom line. We get there in different ways. My export target is smaller. My ethanol estimate is higher than USDA's. And my feed usage number is a little bit higher. But I've circled that export number there because that could still change dramatically depending on what USDA does with Argentine and Brazilian corn production. That could still dramatically impact next year's exports, either up or down. That's going to be the key. Based on these numbers I derived by developing my global spreadsheet for supply and demand, we're building stocks slightly. Actually, yeah, we're building stocks slightly. But I want to point out here, alternative number one, I have a 5% below trend yield. And we end up with a 9.2% stocks to use ratio, 1.359 billion bushels. The market would care about that, I would assume, once you drop below that 10% level. So we're not immune to a weather problem this summer. It's just we don't have evidence of it at this time, and we don't know whether it will develop or not. We should learn a lot over the next few weeks. If we look at soybean shipments year to date relative to the seasonal pace, they exceed the seasonal pace needed to hit USDA's target by 27 million bushels. I think we're going to see that 27 million bushels slowly erode away over the next couple of months. My export target is still about 5 million bushels above USDA, but basically sales to China are down 23% year on year. And the bigger concern is new crop sales of soybeans to all destinations. They just don't exist. Buyers are not worried at all about tight supplies. And that's the key. That's a concern. That's a real problem. China is actively buying Brazilian soybeans, and not just for this summer's delivery, but for next winter's delivery. but they're very sluggish on buying any U.S. soybeans, let alone other customers as well. If you look at monthly crush, and this I was talking about, we saw the big drop off in April. I'm looking for the May number to pop back up here, closer to the upper 190s to 200 million bushel range, probably upper 90s, like 197 or so for total crush, include NOPA and non-NOPA members. We'll see. I may be way off on that, but we'll see. But we're still exceeding year-to-date numbers. We're still exceeding the seasonal pace needed at USDA's target by 24 million bushels after today's downward adjustment in the crush target. Let's look at soybean condition ratings. Here again, pretty good. No real problem areas. The weak link, so to speak, right now is Kentucky, but it's 63% good and excellent. We certainly have seen worse. Where do we go from here is the key, and that makes weather kind of the key going forward. Soybeans, not really many changes on here other than USDA cutting their old crop crush target by 10 million bushels. And again, my alternative number one uses a soybean yield estimate that's 5% below trend, and we do tighten up stocks to 5.8% stocks to use ratio where the markets start carrying, but that export number is going to be the key. What do we see coming out of South America? This is a good place to stop and talk a little bit about Brazil. We saw the soybean complex rally here a few days back because of a report that the administration there, via executive order, had pumped up taxes for corporations. There are basically two taxes there that corporations paid, that the difference between those two taxes they could get back in as a refund or apply the difference to their corporate taxes. And the administration in Brazil, by executive order, said, no, we're not going to allow that anymore, which is effectively about a $5.6 billion corporate tax increase. Now, the executive order took effect immediately, but it had to be ratified by Congress within 100 days to stay in effect. And the thinking is that with these raised, elevated tax obligations, that we would see profit margins shrink, crush margins for processors shrink, therefore processing fewer soybeans, selling less soy oil and soy meal onto the world market, making less biofuel, that it would reduce, that would shift that demand to Argentina and to the United States. But then late yesterday, we learned that apparently the Senate president said, we're not going to ratify it. And they sent it back to the administration. So now it looks doubtful that it's going to happen. And the administration is scrambling to figure out what to do to come up with the revenue that they were hoping to get from that. And so the story isn't over, but for now that tax is off. And what the currency market is currently worried about is, will Brazil be able to make its payments it needs to make, its debt payments? So we've seen a sharp drop in the value of the real, although it's recovered quite a bit today. Earlier in the day, it was a sharp drop. When that drops, it increases the value of Brazilian soybeans. And my contacts down there, or people down there, say if you get a little bit more firmer, because farmers don't want to sell, you get a little bit firmer basis combined with weakness in the currency, and you could see a lot of soybeans sold, because they are still behind in both corn and soybean selling overall. Now, I did see that we have a question come in, and so I'm going to get ahead of myself and answer that question because it's relevant. I've talked about corn and I've talked about soybeans. And the question is, now I've talked about the balance sheets, I've talked about the weather. Do I feel like the weather has reduced the potential yield of corn and soybeans at this time? I'm not going to make any friends with this answer, and I don't have anything at stake in this answer, either positive or negative, even though people may think that I do. I don't. But no, I don't feel it has. Has it locally? Absolutely. But when you look at the big picture, and this is a discipline I've had to develop over the last 4 decades, is looking at the big picture, not what it's doing in my area. We have some locations in this Midwest where it definitely has reduced the yield potential of the corn and soybeans. But we have many other locations where the weather has been favorable to give them above trend yields, so thus far offset those losses. That may change. It may change rapidly here over the next few weeks, depending on how the weather plays out. But I don't think we can justify a reduction in USDA's trend yields yet. And we'll just have to see how things play out over the next several weeks and we establish that summer weather pattern. Going back to the Black Sea region, excuse me, the top graphic there shows NDVI satellite scores for vegetative health over the wheat belt, a southern wheat belt, I should say specifically. See that they're well behind average, record lows for the 2000s, basically from 2001 on. So the crop is definitely under stress. It is earlier maturity, which would also hurt these NDVIs some, but there's more than that at stake, it looks like. The bottom graphic is looking at the key production areas of Ukraine, particularly in central and eastern parts of Ukraine, still within the range of the previous 20 years, but getting to the lower end of it. Now, the correlation between these graphics and yield is weaker than what I'd like to see, but it is a tool to use in assessing the health of the crop. And I continue to say what I said last month, that I continue to think that the Black Sea wheat situation is one of the most intriguing stories in the commodity world right now. And the story, I think by time we meet for the June 28th stocks report, we're going to know a lot more. And especially by the July crop report, because we're going to know a lot more here over the next few weeks, I believe, on the lost production there and how that might impact exports coming from that region. Winter wheat condition index scores. Now, I showed you good to excellent ratings for corn and soybeans because in most years, that correlates to yield just as well as my condition index scores. But when you have some bad ratings, the condition index scores perform better. And we do have some bad ratings in parts of the central and southern plains. That's why I'm using condition index scores here on the winter wheat crop. You can see the soft red winter wheat crop in the Midwest is in really good shape. You can see that Kansas has a lot of problems. Those problems extend west into eastern Colorado and southwest into parts of Oklahoma and to Texas. And so there's some problems in those areas. If we look at winter wheat yield and change month on month, in other words, the June numbers minus the May numbers for yield, we can see that USDA this month raised their yield estimates basically across the central and northern plains into the much of the west, decreased it in Idaho, Colorado, Tennessee, and North Carolina. We saw a mixed bag in the Midwest as far as yield changes in this report. When we look at total production, which is acreage and yield, you can see that we lost production in the soft red winter wheat belt pretty much across the board. We gained production in the hard red winter wheat belt year on year. This graphic is year on year. The previous one on yield was month on month. This one looking at total production is year on year. So no real surprises there. It's consistent with what we're hearing. Harvest results now up into southern Kansas from Texas and Oklahoma, better than expected overall. Spring wheat condition ratings generally pretty good. When we look at our wheat balance sheet, we're growing supplies. Now, USDA taking exports up to 800 million bushels does help, but their ending stocks number is really close to where I'm at overall. Fund positions. We've gone from record to near record short positions to now modest net long positions in this wheat market. I have a feeling when we get Friday's data that takes into account yesterday and the week prior, that we will have added some shorts back into the market. So here's the take-home points. Commodity deflation, that theme of commodity deflation is ebbing and flowing, but overall it's weakening in my view. The world is amply supplied with corn and soybeans currently, yet the corn and soybean balance sheets are not, that should be not note, are not immune to weather problems this summer. Wheat is still vulnerable, in my opinion, to the Black Sea shortfalls. We should learn a lot more over the next few weeks. A strong dollar adds headwinds in the near term. Now, the dollar did break hard on today's CPI numbers, but longer term, we're still facing a strong dollar to create some problems. I do believe a big part of that is reinflation risk continue to rise as a longer term factor in this market. So with that, I'm going to turn it back over to Cheyenne and Whitney and see if we have any more questions. Feel free to submit any questions that you might have. We'll answer as many of them as we can. But then again, maybe I did answer them all as we went through. We just noticed that one, but we'll give you a minute or two to see if any more questions come in from today's discussion.
Okay, do you feel that weather has reduced the potential yield of corn and soybeans at this time?
Only locally, only locally. Overall, when you look at the national picture, I think we've had enough good areas that have offset the poor, and that could really change in the weeks to come. But for now, I don't think we can justify it yet. Maybe there's no more questions today. All right. Well, if you do have any more questions, oh, we had one come in. There, so we'll go ahead and take it.
Any thoughts on if we are going to have a strong drying season in the Corn Belt this winter?
Strong drying season. That's a good question. We're looking like we're going into a La Nina by the fall and the winter. That tends to give us dry weather across the south, more of a stormy picture toward the north. We'll see how that plays out. Confidence isn't real high at this point in what it's going to be. We'll have to see how that plays out because the models are not in agreement at all as we go into the fall into winter.
Any new news on India coming to the wheat market?
Good question, because that could have a significant impact on market psychology. India has basically been increasing consumption of wheat at a faster pace than it's increasing production of wheat. And so its balance sheet is tightening. And so we've been anticipating that they would eventually become an importer of wheat. And in fact, that's the general thinking right now in the marketplace is maybe 3 to 4 to 5 million metric tons of imports in this current new marketing year. I don't know that it's going to be this year, and I'll tell you why. Is we went back and looked at rice stocks, and we found that India rarely imports much wheat when their rice stocks are big. They're kind of interchangeable as a food grain, and their rice stocks are elevated this year. So I'm not sure that they will import wheat this year. If they do, they'll most likely get them from Russia, and of course, we're looking at a smaller crop from Russia. So that's why I think it would become a market factor, helping offset the lost turkey production. And I should probably talk about that a little bit about Turkey. Turkey saying it would not import wheat between June 21st of this year and October 15th, roughly a third. So factor about 2.5 to 3 million metric tons of lost business, lost imports. And they generally take about 2/3 of that from Russia and 1/3 of it from Ukraine. So if you look, Russia was originally going to have about a 94, 95 million metric ton crop. USDA currently has them at 83. Private sources closer to 80. You've offset a bit of it, but the big problem is you've offset it at a time of Russia's harvest gut slot export time when they need to be moving it out the door. That's one reason you're seeing the market move lower now, is because of that. You start bringing India back in, that would be a big factor, but maybe not toward the last half, until we get to the last half of the marketing year.
Are your crop conditions index developed by you, or is this data available somewhere?
It's developed by me, and if you're a customer of StoneX, you can access all the data and stuff on our market intelligence portal on the interactive report on crop progress and conditions that updates each Monday afternoon when USDA releases new data.
Do you see a lower efficiency of corn to produce ethanol this year comparing to last year?
Well, it's been highly variable, I'll tell you that. As I update to the EIA data, between USDA and EIA data, I update my calculations each month, and it's been pretty variable. But overall, yeah, I do see a little bit of shift in that direction, yes.
Do you think USDA's 24-25 soybean crush number is feasible even with lower crush margins?
Right now, my crush target is higher than USDA's for the 24-25 marketing year. We're still anticipating that we're going to see that demand come back. Crush margins overall have been, I'd say this, we saw the big drop in April. I think we're going to see a bounce back in May. That's going to give us a better feel. That's really what I want to see before I make any adjustments to my 24-25 balance sheet. Overall, we're expecting the demand from the biofuels to be there. The question is, will we get anything done about the tremendous amount of used cooking oil that's coming across our borders into the United States, especially from China? And that's a big unknown. That may not happen prior to the elections.
Any thoughts on storage capacity and farmer marketing pace?
Storage capacity has definitely increased in recent years. The farmers build storage and feel like they need to pay for it by having something in, and sometimes that's a curse. Storage capacity can make money for a farmer, or can lose money for a farmer. It can make money in those years and you have a lot of carry in there, or you get a big rally in the market. It can lose money if it keeps them from selling when they should sell and they miss the market signals. And I do think that overall, the fact that they're not in commercial storage to the same extent and not having to pay those commercial storage costs, they lose the fact that they're losing opportunity costs with interest rates being higher in doing so. And I think it is contributing to a slower marketing pace, yes.
Do you think the goal for ethanol of the old crop released by USDA today is achievable?
If we look at ethanol, I think that USDA still could end up having to raise its target, whereas we're well ahead of the seasonal pace needed to hit USDA's target for ethanol right now. So I think it may need to be pushed a little bit higher yet.
China is also having a great wheat harvest. Does that help offset Russia?
It does, but China doesn't export wheat. It doesn't like to do that. It likes to preserve it for its own food supply between wheat and rice. So it doesn't really make itself an exporter. So it has 53% roughly of the world's wheat supplies, surplus supplies, but that doesn't really matter. So we generally look at global wheat supplies minus China. The question is, what will they be doing from an import standpoint? And a year ago, they'd had a tremendous harvest. It looks like this harvest will be even bigger, but a year ago they had a lot of rain during the harvest. And so they had a lot of quality problems. So it pushed about 20 million metric tons into their feed stream because of low quality, which meant they had to import more quality wheat to offset that loss of that quality. This year doesn't look like they're going to have the quality problem, so they won't need to import as much as a result to make up for that they did last year. Therefore, they won't be feeding as much wheat as they did last year as well, and that should help with corn demand.
It seems like the worldwide weather and geopolitical news have driven the commodity markets of late. How much of an impact do you expect the U.S. yields plus CO plus use ratio may impact the future markets this season?
Yeah, carry-out use ratios, I think, are significant. Pivotal level is 10%. Projection for corn, 5% for soybeans that the market seems to care about. So that's what we're going to have to pay attention on future production balance sheets coming out. Right now, we're well above it on both of those unless we get a decrease in yield. Yeah, geopolitical risks are going up. We saw another bulk freighter hit, was it today, by a unmanned drone boat by the Houthi rebels off of the coast of Yemen. And they're threatening now to start attacking ships in the Mediterranean as well. So those geopolitical risks are going up. Fortunately, we're looking at the Panama Canal opening up to more ships and getting that situation getting better. The geopolitical risks in Black Sea are going up, and China are going up. The Black Sea are potentially bullish. The Chinese risks are potentially bearish for U.S. commodities. But overall, market is still looking at those carry-out to use ratios, and they still remain ample to meet that demand.
Do you think the decrease in ag land is connected to the relatively low margin period between 2014 and 2019, coupled with asset transfers we saw during that time? Is there a delay? Could we see a rebound in acres in the next couple of years after a couple of years of relatively high profit?
A legitimate question, but no, I don't. And that's because farmers farm. And we just don't have land sitting idle, with the exception of in the far western high plains where rainfall is a problem. They may idle land for a year, waiting for the rain to refill the soil profile to grow a crop the next year. But even that is much less than what it used to be as we've improved our genetics and drought tolerance of our crops. So overall, I don't see that as a reason for the lost acreage. In fact, it's very difficult to explain the USDA's lost acreage numbers right now. And I keep looking for this opportunity for a rebound in acres. I don't see it. We do get a bouncing around from year to year. As I showed you that one graphic for the major crops, there was quite a bit of bouncing around, but the overall trend is still lower.
Has the Red Sea crisis affected grains shipments? Are Black Sea cargoes going through, or do they go around the Cape like almost everything else?
Well, that's interesting because China basically, a lot of that Black Sea grain is going to China. And so China basically told Iran, and these are basically believed to be Iran-backed rebel groups that are doing this threats to shipments going through the Red Sea and through the Suez Canal. And China told Iran, you had better not allow any ships coming to us to get attacked. And lo and behold, they haven't been. So shipments to China have been moving through, and that's continued to go. But a lot of the other shipments have to go around Africa if they're going to Southeast Asian markets, which is a critical market area. So shipments of bulk cargoes have dropped more than 50%. Some would say a lot steeper than that, largely because of that. Oh, the other part of the question was Black Sea. We're still seeing grain flow through the Black Sea itself. That is a risk going forward, but so far, neither side has chosen to sink a ship. They both have the capability. Thus far, neither one has chosen to do that. And so ships are still moving freely, and we're basically seeing as much exports as what each country wants to export they're able to do at this point yet.
I know that you don't like to talk about price, but given the soybean S&D for 2024-2025, don't you agree that we could see soybean November at 1,000?
Yeah, $10. Basically, I have to be careful here, and we'll walk this line, because with compliance, the way we're structured, I'm not allowed to forecast derivatives, but we can talk about cash prices. And with cash prices based on history, with the supply and demand balance sheets being what they are, history would argue that there is a risk of the marketing year average cash prices dropping below that $10 level as well. And I'm taking a quick look. I'm basically looking at that. If we would get a trend or higher yield, we have that risk based on history of the marketing year average cash price dropping below that $10 level. And you can make your own assumptions what that means for futures prices. So I believe that is all the questions that have come in. If you have additional questions, you can look me up on X and direct message me there. But thank you very much for being with us again today. We'll be back on June 28th to talk about an update on the weather patterns for the Midwest and how that is shaping up, to talk about what we see in other parts of the world, but more specifically the new acreage numbers and the quarterly stocks numbers. There tends to be surprises in there that tend to impact the markets. And we look forward to seeing you then at that point. So thank you very much, and we will see you on June 28th. Thank you.